Hi everyone, we just had the Portfolio Advisory Board meeting, so let me give you the macroeconomic outlook as we see it, and then Ricardo in a couple of minutes will tell you our tactical positioning. So the key issues are three. We see synchronized global economic growth. That's a very positive economic backdrop for financial markets, but this could lead to more inflation, and this is one of the risks we foresee. Risks are also coming from the political side, and we actually see some political headwinds both in the US and in Europe and also in Syria. And risk also is the fact that this inflation, this could be actually one reason which could mark the end of the turboprop phenomena, which has been TINA. We remember TINA, I believe we mentioned that in a previous video. There is no alternative. It's the fact that many investors have been piling into equities because of the lack of alternatives in terms of yields on fixed income investments. Starting with the global economic picture and starting with the US, what we see here is that consumer confidence is sky high. Indeed, it's very close to the peak it reached at the end of the 90s. You see this from this blue line of the University of Michigan Consumer Confidence Index. And that is also a turboprop. It's actually boosting consumer spending, the red line here on this chart. What is good news for the US economy is also very positive news for the world economy. And indeed, you see here this blue line, that's world economic growth. And you see it on the right-hand scale, it's approaching fast the 4% threshold. Indeed, the IMF has just released its forecast for the world economy, 3.5% this year, rising to 3.6% or even 3.7% next year. So, and you see the correlation here between the world economy and US consumption, which accounts for just under 20% of the world economy, is very high. So in terms of the economic picture, it's a very positive one for equity markets in particular. If there are risks for these equity markets, they are more of a geopolitical nature. On this chart here, we've put an economic policy uncertainty index in France. Obviously, France is now facing a major election, the presidential election now. We believe Emmanuel Macron will make it, but we cannot rule out the black swan, actually a pretty fat black swan, that Marine Le Pen could make it, which would obviously be very bad news for financial markets. But past this French election, we will have more down the road, and a major one also in Germany. So some political risks in Europe, also in Syria, with a possible fight between the US and Russia over Syria. There is an additional risk, last but not least. It's the risk, as I mentioned, that bond yields could rise to such a point that bonds become more attractive to investors, which would then mark the end of the so-called TINA phenomenon. So the questions we ask ourselves here at Novastones is, what could be the factors which could make those bond yields increase to a point where we would become very cautious about equity markets? Well, there are a few candidates here. Growth, number one, and the consequence of that, inflation. Inflation would clearly be a reason for bond yields to increase. But factor number two, this rise in inflation could actually come from the oil side. We could have an oil-induced shock to inflation, and this could also be a reason which would propel bond yields up. And last but not least, we could also have some pickup in bond yields coming from central bank policy. Actually, the end of their loose monetary policy. Indeed, we have had the central bank in the US, the Federal Reserve, which has announced very recently that it wants to shrink the size of its balance sheet. So that could be bad news for bonds in that it would lead to a pickup in bond yields. So we will come back to this over the summer because the Federal Reserve has announced that it will start implement this policy towards the end of this year into 2018. So in a nutshell, what we see is synchronized global economic growth. That's obviously a very positive piece of news. We still want to see whether this kind of very positive news will lead to a less positive news, which is more inflation. We see synchronized economic growth, but desynchronized monetary policy, certainly between the US, which is a restrictive monetary policy. It has increased interest rates this year. It will probably deliver 2 more hikes in interest rates, whilst at the same time the ECB, the European Central Bank, will remain on a loose monetary policy. If there are risks, they are more of a geopolitical nature, both in the US, in Europe certainly, and over Syria. And last but not least, we are monitoring very closely the risk that bond yields could rise and mark the end of TINA. Now, I think it's a good time to ask Ricardo about our tactical positioning. Ricardo?
So what's the implication in portfolios? Well, we are neutral in our 2 main portfolios. As you remember, we have a risk-on portfolio that is called NS Capital, and we have a risk-off portfolio that is called NS Reserve. So when we look at both portfolios in a top-down view, we have a neutral view on both of them. And what we have been doing in the risk-on portfolio is we continue to build our positions in emerging market equities by focusing solely on Asia-Pacific, on the Asia-Pacific region. And we recently added a tactical position in Indian equities, and we have a small tactical allocation into Russian equities. On the spread product side, we continue to build this portion of the portfolio by now focusing on emerging market debt. So that is a mix between local and hard currency debt. So on the risk-off portfolio, we see an attractive entry point for investing in inflation. So we added a tactical allocation into US tips. And in terms of our hedge fund portion of the risk-off portfolio, we are molding it to have only strategies that are diversifiers against the equity market risk. So as you can see, by using our 2 main portfolios, we can balance the risks that Michel spoke before, and we can also participate on the upside that we can have with synchronized growth. And please, any question, just write us an email and we'll be happy to answer.